ETFs, the good, the bad, and the diversified. Hey there, money mavens and portfolio planners. Today we're talking about ETFs, exchange-traded funds. What are they? Why do people love them? And are they the financial equivalent of sliced bread, or do they have a few moldy spots? Let's dive in with a little humor to keep things lively. Let's start with the basics. An ETF, or exchange-traded fund, is like a buffet for your investment portfolio. Instead of buying individual stocks or bonds, you're getting a pre-made platter of goodies. And who doesn't love a good platter? For example, if you buy an S&P 500 ETF, you're essentially buying a slice of all 500 companies in the index. It's like owning a piece of Apple, Microsoft, and even that company you've never heard of, all in one go. And the exchange-traded part, that just means you can buy and sell these funds on the stock market just like a regular stock. It's easy, flexible, and a lot more exciting than waiting for a traditional mutual fund to process your order. So ETFs are basically the cool kids of the investment world. All right, let's talk about why people are so obsessed with ETFs. They've got a lot of perks, and I promise it's not just because they have a fancy acronym. First up, ETFs offer instant diversification. Buying one ETF can give you exposure to hundreds or even thousands of stocks or bonds. It's like buying a single lottery ticket that covers all the numbers. Well, almost. Why put all your eggs in one basket when you can have an entire omelet station? ETFs are famously cheap. They often have lower expense ratios than mutual funds because most of them are passively managed. In plain English, that means they're not paying some fancy manager to pick stocks. They're just following an index. Think of it as hiring a GPS instead of an expensive chauffeur. You still get where you're going, but for a fraction of the cost. Because ETFs trade on stock exchanges, you can buy and sell them throughout the trading day. No waiting for end-of-day prices like mutual funds. It's instant gratification for investors. Need cash? Selling an ETF is faster than deciding what to watch on Netflix. ETFs are generally more tax efficient than mutual funds. Thanks to something called the in-kind creation and redemption process, they don't trigger capital gains as often. It's like eating cake without gaining weight, a financial miracle. Now, before you rush out to load up on ETFs, let's talk about the downsides. Yes, even the mighty ETF has its flaws. Think of these as the fine print in the investment fairy tale. While ETFs are generally low cost, you still pay trading fees when you buy or sell them. If you're trading frequently, those fees can add up faster than you'd think. It's like ordering too many $1 tacos. You think it's cheap until the bill shows up. Because ETFs are so easy to trade, some investors treat them like stocks and try to time the market. Spoiler alert. Most people are terrible at timing the market. Day trading ETFs is like trying to guess the weather in 5 minutes. It rarely ends well. ETFs aim to track an index, but sometimes they don't do it perfectly. This is called tracking error. And while it's usually small, it's still something to watch out for. It's like ordering a pepperoni pizza and getting one with pineapple. Close, but not quite right. Some ETFs are ultra-specific, like solar-powered companies in the Arctic. While niche ETFs can be fun, they can also be risky if the sector tanks. It's like putting all your chips on a single roulette number. Exciting, but not exactly a sound strategy. Not all ETFs are created equal. Let's take a quick tour of the ETF universe so you know what you're dealing with. These track a basket of stocks, often mirroring an index like the S&P 500 or NASDAQ. Perfect for stock market enthusiasts who don't want to pick individual companies. These give you exposure to bonds without the hassle of buying individual ones. Think of them as the chilled-out cousin of stock ETFs. Want to bet on green energy or tech stocks? These ETFs focus on specific industries or themes. Just don't go overboard. Remember, diversification is key. Ever wanted to invest in Europe, Asia, or emerging markets? International ETFs make it easy to go global without a passport. These are the daredevils of the ETF world, aiming to double or triple the daily returns of an index. High risk, high reward, and not for the faint of heart. So, are ETFs for you? The short answer is probably. They're great for beginners, seasoned investors, and everyone in between, but here's the catch. You need a plan. ETFs work best as part of a diversified portfolio. Use them for long-term growth, steady income, or to hedge against risks. Just don't treat them like lottery tickets. Investing is a marathon, not a sprint. In summary, ETFs are like the Swiss Army knives of investing, versatile, efficient, and accessible. But like any tool, you need to use them wisely. Whether you're a beginner building your first portfolio or a seasoned investor looking to tweak your strategy, ETFs can play a starring role. Just remember to watch out for trading fees, avoid overtrading, and don't go too niche unless you're ready for the risks. So go forth and invest confidently. And if you're still unsure, talk to a financial advisor. They're like a tour guide for your investment journey.